All right, welcome to the 5 a.m. grind. Horace, what's up, man?
Nothing much, man. What's up with you?
It's good, man. It's good. You know, Ontario moving into stage 2 now, earlier than anticipated.
Oh, yeah.
Yeah, I can't
Finally,
wait.
man.
I can't wait to get a haircut. I don't know if some of the viewers have noticed, but my hair is actually wild.
How have you been cutting it?
I haven't been cutting.
You haven't at all?
Not at all.
You don't like try to trim it or anything?
No, not at all. Not at all. I've let it grow, and like I don't know if you can see, but I look like a mad scientist on the side here. And you can actually see what is this. Actually, I'm not going to point this out because it's disgusting. It's actually quite bad. Anyways, all right. So going into today's topic, I thought we'd cover the topic of debt. Remember we did real estate a couple of weeks ago, just Canadian real estate. So I wanted to cover debt. And here are the questions I wanted to discuss today. So number 1, why can debt be bad for you? Number 2, why are Canadians highly indebted? 3, what's good debt and bad debt? Number 4, when someone offers you a mortgage or some debt, should you take it? And last but not least, if we have time, should you tap into the equity of your own home? All right. So why can debt be bad for you? Usually. I think we can answer this pretty quickly.
Are you taking it from more of like a personal or a business perspective?
Let's take everything, any kind of debt. Okay. Any kind of debt. And maybe we'll answer number 1 and number 3 at the same time. Why can debt be bad for you, and what's good debt versus bad debt?
Yeah. So, yeah, you want to start?
Yeah, no, sure. I think good debt, and I'll put this in quotation marks always, good debt is always the type of debt that you take to buy an asset. So this is either an income-producing asset like a business, or you take debt to buy real estate as an investment, or as, I wouldn't call a home a good investment because a home isn't really an investment. You live in it. It's not really an investment. Unless you're buying real estate to flip it at a profit, then okay, you can say that you're using debt to buy an asset. But generally speaking, at a very high level, if you're using debt to buy an asset, I think that's pretty good.
Yeah.
If you're using debt to fund expenses and buy something that depreciates in value, I'd say that's a bad form of debt.
Yeah.
So I guess it depends on what you're using the debt for.
No, I agree. And I think the biggest misconceptions people have is that like they feel like you just stated, that buying a house is an asset. Your house is not an asset. You actually have to put like money in for maintenance, property taxes. There's so much that goes into a house, right? And then like every 5-10 years, you're renovating this and that to make sure that like the upkeep is there. And sure, it could appreciate, but that's not every single market, right? Normally, markets are like, I know in Toronto and in a lot of the bigger cities in Ontario, you have the same thing happening in Florida and Texas, where prices are just skyrocketing. Those are abnormal markets, right? So it's not like, I mean, the prices for everything is going up, not just houses. So for that, like, I mean, that's more like if you want to work off of an appreciation and hope that it appreciates enough so that you're making some money, you're still not, it's not like there's no cash flow, right? You have to like refinance it and you pay off, it's not making you money. You know what I mean? So in that case, I mean, for your house and stuff, I always think that debt is never good. Not saying that you shouldn't take out a mortgage, but it should be within like reason.
Within reason. And I guess we'll cover that as well as we go through some of these questions. But I just did want to double click on what you just said. So what we're saying is, if you're buying debt to buy a house for yourself, it's okay. It's understandable. But what if you're buying debt to just take advantage of increasing prices in residential real estate? Because let's be honest, residential doesn't cash flow well. Everybody knows this. Residential real estate, if you're buying it, especially in a market like Toronto that is, really priced to perfection, I'd say. You're not really making very good cash flow if you're buying residential real estate as an investment in Toronto. You're likely maybe even at a negative cash flow. I do own a condo. I can tell you, some months it's not doing that well.
No, because it's the thing is if it is fully tenanted, the entire time, your cap rate's what? It's very low.
On a condo?
Yeah, it's like, or any kind of residential real estate in Ontario. It's not that high. I'm guessing 3 to 5%. Right? So, or maybe even lower, right? But now if that tenant just leaves for 1 month and you're trying to look for somebody,
You're screwed.
it's done.
And it's 3 to 5% before the cost of the debt as well in residential. It's stupid. It's completely insane.
So then it's like you have everything gets washed away as soon as
it all goes to the mortgage.
As soon as somebody decides, okay, I'm going to go rent somewhere else, and then you have to find somebody else. 1 month, first of all, you're not getting rent, and then you may have to pay a realtor to find you somebody, right? So you're never really on top of it at all, right? The only way you're making money is appreciation over the long run.
So you're banking on appreciation. Absolutely. Absolutely. I did want to cover this next question where we can talk about this topic a bit more. Why are Canadians highly indebted? Well, I think we know what the answer to this is. It's clearly because we have a lot of mortgage debt. Our housing prices have gone astronomically high. As a result of that, people are taking on bigger mortgages because they have to buy these more expensive homes. Just some stats here that I've pulled from the internet. So Canadian debt to income. So debt to income, which is basically the amount of debt Canadians have for every dollar of income they get. It's at 170%. So for every dollar that Canadians make, they owe about $2 in debt.
That's insane, man.
They're about $2 in debt. In terms of just even the country as well, which I think is interesting. So this is the country's debt, right? So the federal government, provincial governments, that's also, we're borrowing higher than our GDP. So it's over 100%, you know? I
think.
What do you think about this state of affairs?
But like with the country, right? We're kind of we're not too far off from, and probably better off than other, I guess, G7 nations, right? In terms of debt to GDP. I don't know the stats. Right? But this is what I would say. But in terms of the debts that individuals have to, like private debt, I think that's some of the highest.
Yes,
right?
actually, if you don't mind me interjecting, you're absolutely right. So Canadian public debt, this is just the federal and provincial government's debt combined. I don't know what it's like. I think the U.S. might be higher than than our country is versus Canada.
Or percentage-wise?
Percentage-wise, as
GDP to GDP, U.S. is definitely higher.
Correct, exactly. But what you just spoke about, so private debt, so household debt to GDP. I saw a stat comparing Canada versus other countries. So this is just strictly household debt versus GDP. We are at 110%. That is the highest amongst the G7 countries. Second place is Great Britain at about 89%. We're the only country over 100%. So that means Canadians, individuals, right, not the government, have more debt than our country's GDP. And we're the highest when it comes to this.
No. I mean, I was looking at that, and I was also looking at stats because, I mean, the market's been going crazy in Ontario, and they were saying, or in Canada in general, they're saying that we have one of the worst ratios between rent and the price of real estate. So the assets aren't like producing that kind of income, right? I think there's only one country ahead of us. I think it was Denmark or some European country, but that's it, and we're number 2.
Wow.
So in terms of, and what I'm trying to say is the relationship between the rent you receive and the price you pay for real estate, Canada is one of the worst countries in the G7 or even in the West. Which
goes back to the point we made when we started this podcast, which is that when you're buying residential real estate expecting to cash flow, you're not going to cash flow because of this weird phenomenon that we have where rents are just not, they're completely... versus prices, are the relationship is completely wacky.
It makes no sense.
Yeah.
It's a bunch of like, I mean, what's scary about this is this kind of relationship that develops between the rent and the price is more what developing nations have, where there's no correlation between the income residential real estate produces versus what you've paid to get it, because it's basically haves and have-nots in the developing world. So people will pay whatever they can to get a real estate, and then they'll rent it out. Doesn't matter, but they've paid cash. So we're moving more towards the have and have-nots, where
we definitely are.
People like if you have real estate, you have real estate. However you're affording it, that's a different story. But then people are renting it can't the discrepancy is so much that it's not. There's no correlation between the rent and the asset price.
And eventually people who rent will always rent. They'll never be able to afford a home. Like in some countries.
But here's the thing, though. I mean, does it make sense for you to buy a house if you can rent it cheaper.
No, it's true.
You know, like home ownership always, it doesn't make sense. I know it's a dream we're sold.
Yes.
Right? And I feel like personally it's sold to us because, hey, you get a mortgage, now you can't leave your job. You're going to be a really good employee when you need to make those mortgage payments, right?
Yeah.
So from a society perspective, to get people working, okay, and, you know, making sure that they have to work, mortgage is the best thing that was ever created, right? But in terms of the quality of life that you live, right? Again, I am pro home ownership, but I'm just saying in a market where it's cheaper for you to go out and just rent, I would rent all day long. You know what I mean? Because it makes no sense. Why would I want to put up with property taxes, this and that, whatever, when like I can't get up and leave that easily with renting, you know, you buy after like whenever your lease is over, you can move wherever you want.
You don't have to put money to repair the home and
there's no stress in like freaking selling it or any of that stuff. Right? So it's like you leave, but then like it just makes it more attractive. The fact that you don't have to, like, you're not paying the entire amount it takes to upkeep that asset. That's another bonus.
Yeah.
Even on an ongoing basis.
No, agreed. I did want to underscore 2 points. I wanted to make 2 points. The first one is, which you touched on, the thing about debt is it removes all the flexibility you have in your life because, like you said, you have a mortgage and you're sort of on a hamster wheel. You're required to have a steady income, employment, and a job to pay the mortgage, right? And the circle goes round and round because that mortgage payment needs to be made every month, and you need a steady income every month. And it's like you're stuck on this little Ferris wheel. And what that removes out of your life is just the ability to be flexible, to take risks, to start a business, to do something else. You really can't because that sort of narrows the amount of choices you have in terms of what you can pursue in your career and in your life.
Yeah, there's no flexibility. You can't maneuver at all, and that's what you need in a business, right? And I think that there was an article recently. I don't forget which newspaper it was on, that Canadians in the future, there's going to be less Canadians trying to start a business.
I read this article,
right?
Yeah.
But it's perfect, you know? It's
you
like,
and I were talking about this, yeah.
It's like, it's perfect because now there's less competition in the marketplace, right? So it's like, that's the type of mindset, because you can't really just get up and do whatever, right?
Yeah, no, understood. Like, let's be honest. When you have debt, you can't. It's harder for you to start a business. So yes, entrepreneurship will go down as a result of these highly indebted Canadians.
Yeah.
Right, they start less businesses. I did want to cover one concept though, and I think this concept sometimes gets lost from a lot of people who sort of aren't very financially savvy, or, you know, don't have like a background in business or finance. And that is the concept of leverage. Leverage is a beautiful thing. It's a beautiful thing when it works, right? I'll go through a simple example as to what I mean by leverage. And leverage, essentially, when you hear that word, it's basically using debt to buy an asset, and then hopefully that asset appreciates in value or sometimes declines. Like, I'll go through an example. So very simple example. Let's say you buy something for $1,000. Okay, you bought an asset. Let's say it's a house for $1,000, hypothetical. You put down $200. That's your equity. You borrow $800 from the bank. Okay, so $200 down, $800 from the bank. You paid for that asset that is worth $1,000. Let's say in a year, that asset is now worth $2,000.
Yeah.
Okay, so it doubles in value. You decide to sell that asset after that year. So you sell it for $2,000. You take that money. You pay the bank's debt, which is $800. Yeah. You are now left with $1,200. So that investment you made, the $200, is now, you came out with $1,200. It went up 6 times. And this is why when a real estate market is going the way it has in Canada, it is amazing. And you see this a lot because Canadians tend to flip houses. They move from one house to another. One of the reasons why they do that is because you're able to use leverage, like I just described, to get this massive gain on the equity you put down. The other thing is, in housing, that gain is actually tax exempt. So you're not even paying tax on it. Yeah. So it's been amazing when prices go in the right direction. Yeah. But you can imagine when prices do go down, the effect is completely reversed and you literally go in a negative position.
But if you look at it though, if there's a lot of costs that people don't see, Like if you look at from a price perspective, it does go up, right? Recently, we've had like prices go up like 15%, whatever, 20%. You really need it to go at least 12% for you to break even.
Correct. You're saying to cover land transfer tax.
Land transfer, real estate, all those fees. You
know,
need
these cost better than I do.
Yeah. You need at least around 12 to 15% you break even at that point.
Yeah. Yeah.
So that's something that, like, yeah, there's that. I totally agree. There's an upside, and you're taking advantage of the equity that you put in, but you also have to see, like, how much does it have to bump before you get that money back. Mm-hmm. And this is why, going back to your original point, where you use money to buy a business. I don't know. I feel like when you want to build wealth, your perspective is, I am deploying this cash to get some cash back, not like an appreciation, like appreciating on an asset. For example, hoping that like you have like baseball cards that are going to appreciate and stuff like that. It's similar to real estate. Now, real estate is there's more of a guarantee than baseball cards, but it's similar. And I feel like, but people don't understand, and maybe it's just how our society is built, because everybody could get a piece of real estate. The bank will easily give you a mortgage to go buy a house, but they're not going to give you a mortgage to go buy a business.
Mm-hmm. It's much harder.
Yeah, it's much harder, even though it's probably, I don't know, in my perspective, safer to go for the business.
I actually really like that, because what you're distinguishing two things here. You're saying you either use debt to buy an appreciating asset, which will just go up in value, or you buy something that actually cash flows, which is usually a business. Because let's be honest, real estate cash flow is kind of low. Yeah. It's not the same as a business. I totally agree. I'd rather use debt to buy a cash flowing asset where I can sort of increase those cash flows, cover that debt, make some profit for myself, rather than taking that debt to buy an asset and hope that it appreciates in value. But this concept of leverage that I just described, it's used everywhere, right? It's used in housing by individuals, and individuals are familiar with it. But dude, I worked in finance. This is used by hedge funds. This is used by private equity firms. This is exactly how they juice returns on their equity. Yeah. It's the same thing. It's simple math. It's really not that complicated. Yeah. But it's exactly this concept that amplifies returns. Yeah. When they work in your favor, I gotta like really underscore this. Because we've always been in a market where things keep going up because like the interest rates are driven to the floor by the central banks. Right? God forbid interest rates start going the other way, or there is another major shock. Yeah. Right? I mean, COVID's done.
But dude, you know what the irony is? Like what I find to be very interesting. Yeah. If you went out to get a loan, get a $50,000 loan to buy a business, a mediocre business, whatever it is, right? It's going to be near impossible. But you try to get a $50,000 loan to buy a car, it's pretty easy. And that car drops in value 30% as soon as you drive it off the lot. Yeah. Right? So I think there's like, as bad as this sounds, right? It's more like middle-class debt. There's middle-class debt, right? Which the society or whatever is just geared to give you debt for certain things, to consume things. But it's not really geared to give you debt to produce things. Mm-hmm. Do you get what I mean? Yeah. So, and it's only the people who are to our listeners out there who really have a mindset of creating like wealth and to grow proper wealth that you need to get into debt that produces things and not obtain debt to consume things. Because I've seen people, the house price goes up, they refinance and buy TVs and stuff like that. I'm like, what the heck is going on, man? This is hurting me. Because this money here, you're not going to get this back. But a lot of people, it's like YOLO, fine. You will live once, you want to spend your money, whatever. I personally would never, ever do that. I don't need 5 TVs, I would try to get into debt to, income producing businesses, especially assets, you know what? The more nuanced something gets, and I guess this is a tangent, but the more nuanced something gets, the higher the margin, right? Because it doesn't take a lot of, I guess, research or whatever to buy real estate in a market where everything's going up. The cap rates are very low. You know what I mean? But you get into the more nuanced businesses where it takes more aptitude to understand the business, to understand how you're going to acquire business, how you're going to fulfill clients, all that stuff, then your margins are so much better. But I don't think anybody realizes that.
Yeah, yeah, so true. I wanted to go to this question, which I think is a pretty good one. When someone offers you a mortgage or some debt, should you take it? Wanted to answer this question to see what your perspective is. Because let's be honest, when you get a mortgage, somebody offers it to you to buy a house. Let's say you go to the bank, you qualify for $1 million, a mortgage for $1 million.
$1 million is so much.
Should you take it? Should you just, let's say the bank says, oh, I think Harris, you qualify for $1 million mortgage. Should you just take it?
I would never take it.
Why? So why not?
For me, that's a burden.
Right. Okay.
And I understand people, again, are going to be like, oh, my God, you need to buy a house and this and that, get into the market, whatever. But I need flexibility in my life for my business. And if I want to take on debt, I want to be able to move. And that money, as weird as it sounds for people, like, oh, my God, house prices going up 20%, that's a huge thing.
Yeah.
Right? Imagine getting 20% returns every year, year after year. Right, you don't know how often the 20% you're gonna get, like how long that's gonna last for the real estate market. But there's businesses that are cash flowing that give you a 20%, 30%, 40% return year after year after year. Right, so why wouldn't I put my money there as opposed to $1 million in real estate that one year might be 20% up, next year it's down 10%, the next year it's up. You know what I mean?
Yeah.
And really there's no cash coming in. It's just like paper wealth, right? Whereas that business, I'm going to have that number in my bank account going up, and I could take that money, invest it somewhere else.
Correct. Absolutely.
Without touching that asset, without leveraging it, without putting more debt on it, without doing anything to it, I can sustainably increase my wealth.
Yeah, absolutely. On this point, what I was going to say is that...
Wait, hold on. Would you take that $1 million?
Oh, would I take... So, hold on. Let me answer that question. So here's how I would take it. If the bank says I qualify for $1 million, never think that the bank knows what is best for you. The bank is doing what is best for themselves. The bank has an objective. They need to make money. They lend you a bigger mortgage with a shitty interest rate that, given how low they are, they can charge that little shitty interest rate on a bigger mortgage and then make, a decent chunk of money. Right? So the bank has an objective. Their goal is to make a lot of mortgages, make a lot of loans to people so that they can have revenue. They have loan targets. They have mortgage targets. They want to make a mortgage. If you qualify and you're not an idiot, they want to lend the money to you because they need to make money too. But I think when you get that $1 million, you should evaluate yourself if you can actually afford it, right? If you're going to have 2 kids or 3 kids or 5 kids, can you afford the 5 kids and the mortgage? Right? Maybe not. Maybe not. I don't know. Maybe not. You got to wait. You got to do the math yourself. Never assume that just because someone is giving you debt that you can afford it. You need to determine that yourself.
Yeah.
That's one. And sometimes this whole, when someone gives you a mortgage stuff, it works in the opposite way. Like you just said, when it comes to a business, sometimes you go to a bank and you're like, look, guys, I need $50,000 for my business. And then they go, well, look, we're going to look at historical cash flows. It seems like you can't cover this. And you're like, you idiots. Like I can, like my clients right now that I have today, I can increase prices, cover this, etc. But sometimes the bank just don't want to hear it. They're like, oh no, you made this much money. This is how much we can lend. We're scared. We're afraid. But housing, yeah, sure, okay, yeah, we'll whatever. So sometimes the banks, they're also sometimes, they're human beings. They're not perfect. Sometimes they're doing stupid shit, right? So it requires you to sometimes convince them to see the merit of your business and see the value so they can lend there. And then when they're giving you a mortgage debt for your home, don't assume that just because they're giving it to you, you can afford all of it.
I think that is solid advice in that I don't think a lot of people understand that just because they're giving you $1 million or giving you a credit card for $25,000,
or say you qualify for a credit line,
that does not mean anything. It doesn't mean that you should be taking it. It's their job to extend credit in the safest way possible, right? So for them, with real estate, the one thing is for banks, it's like that's not there with a business, is that like if you default, they can sell the house and they'll recover. With a business, it could go down to 0 and they can't recover anything. So there's more risk there in that sense, right? But because they're giving, I've seen so many people just trying to get into a house and they'll take on private money, private lending.
Private debt. Okay.
Yeah, private
what interest rate is that?
It could go from 5-6%, which is really cheap.
Wow.
Right, but never happens. Normally, you're looking at like a stated rate of like 11 to 15%. Effective rate is probably around 20 to 25. Jeez, with all the fees and everything. And people are like, well, you know what? Like, I just need to get into this house. Well, it's not worth it. It is not worth it. You're actually bringing your wealth down, right? You're going backwards because you're paying more than the house is worth. It's better to go rent and save your money than to get into that kind of nonsense. But people just, I don't know what it is. I don't know what the psychology behind owning your own home or whatever it is that people do it at any cost. And in the end, they're worse off.
Yeah.
Right. I've seen people who've tried to get into houses with private money, and they end up losing the house too because it costs too much.
Yeah.
Right. It's like I'm looking at like people getting into debt. Their payments, okay, are $5,000 for a mortgage. I'm thinking this is more like, you know, like a commercial unit or something that like you pay rent on, right? Like this is like a commercial mortgage, but at least that's like somewhat of an income producing asset. Here, it's like there's no income. How are you making $5,000 a month, right? And I'm seeing the income too. Like I'm looking at like
yeah, because don't they give you the entire application?
So when I see their income coming in, I'm like, this guy clearly cannot make that payment.
Yeah.
Right? And then 3 months later, when they can't pay the house, right? Or they try to take on more debt to pay off the old debt, right? The payments of the old debt.
Yeah.
And then that pyramid kind of, the house of cards kind of falls, right? Blown away. They're wondering why it happened and why they owe so much money and have nothing to show for it. It's like, well, look at like exactly what you said. Like just because somebody's giving you money does not mean that it's good for you. Sometimes I feel like some money is meant for you to default on a house so they can take it, you know? It's like the fees are higher when you default.
Yeah.
Right?
Yeah.
I'm not saying that any lender does this. I'm not saying that's their purpose, but I'm just saying it like looks like they just make a lot more money at times, especially when you're throwing on a second and a third mortgage by having you default so they can ask for more fines on top of the 20% interest.
Ask for more fines. And let's be honest, and the market is going straight up. They almost don't even mind owning the assets because they're like, okay, shit, yeah, you can't make their payments, no problem. Yeah. We'll just flip the house. Yeah. So the bank is not really your friend.
Yeah. I mean, then they'll never go for a market where like it's not going up. They'll never those private lenders are not going to be leveraging up to 99% if the market's not going up.
Yeah.
There's no way.
Crazy. All right, so final takes on debt because what are your final takes? What would you say?
I mean, again, debt to consume is bad. Debt to produce is good.
I'd say the same thing. Debt to totally the exact same message. And the last point we just made, if just because somebody is giving you a loan doesn't mean you need to take it.
Solid
all right,
advice.
Do your own math. All right, guys, we'll see you in the next episode.
Take care.
Take care.